Look at this number on the screen, $102 trillion. That is the size of global public debt as we move through 2024 and into 2025, money that governments around the world have already spent and still owe back. But that's only one part of the story. If you add in corporate debt and household debt, the world is now carrying more than $250 trillion of IOUs, roughly twice the size of the entire global economy. For over a decade, ultra-low interest rates made this look harmless. Debt was cheap. Governments borrowed, companies borrowed, families borrowed. But now interest rates are no longer near zero. And hidden inside this mountain of debt is a much more fragile layer, high-yield bonds, also known as junk bonds, companies that promised investors very high interest in exchange for taking very high risk. In this video, we're going to break down how the debt trap works, why high-yield debt is the fuse of the system, and where we might be in the cycle as we head deeper into 2025. This is not personal financial advice. It's a map of the system you live in, so that you don't end up holding the most dangerous part of it. Let's start with the basics. Public debt is simply the money a government owes. When a government spends more than it collects in taxes on salaries, pensions, healthcare, infrastructure, and interest on old debt, it runs a budget deficit. To fill that gap, it issues government bonds and borrows from investors, banks, other countries, and international institutions. In theory, this can be perfectly rational. If a country borrows to build ports, power plants, schools, and digital infrastructure, that investment can raise future growth, and the economy grows faster than the debt. But the debt trap begins when the direction reverses, and debt starts growing faster than the economy. A bigger and bigger share of tax revenue goes to paying interest instead of building the future. And eventually the government has to borrow more just to roll over old debt. For years, ultra-low interest rates hid this problem. When interest is near zero, even massive debt feels light and politicians can delay hard decisions. Once inflation surged after 2021, central banks raised interest rates sharply, and suddenly that same pile of debt became heavier. Bonds had to be refinanced at much higher interest rates, and the annual interest bill for many governments jumped by tens of billions of dollars. This is the first part of the debt trap. You borrow when money is cheap and wake up owing a fortune when money gets expensive. Now layer on top of that the corporate world and the most fragile part of it, high-yield debt. In the corporate world, not all debt is created equal. On one side, you have investment-grade bonds, companies with strong credit ratings, stable cash flow, and a relatively low chance of default that pay modest interest because investors see them as relatively safe. On the other side, you have high-yield bonds, often called junk bonds. These are issued by companies that rating agencies consider riskier. Maybe they are heavily leveraged in a cyclical industry or don't have a long track record of profits. Because the risk of default is higher, they have to offer much higher interest rates to attract investors. In good times, junk bonds can look like a dream. Interest rates are low, the economy is growing, default rates are calm, and a bond paying 7 to 9% per year looks incredibly attractive compared to a government bond paying 1 to 2%. Throughout 2023 and 2024, companies around the world issued hundreds of billions of dollars in high-yield bonds, and many investors happily bought them, hungry for yield after a decade of near-zero interest rates. But there is a problem. The same forces that squeeze governments, higher rates, slower growth, and rising costs, hit weak companies even harder. When revenue slows and refinancing becomes more expensive, the weakest borrowers start to run out of time. Rating agencies have already warned that default risks are rising, and several large, highly indebted names in Europe and the US have begun to wobble. This is where high-yield debt becomes dangerous. It sits at the edge of the system. It's often held by mutual funds and ETFs that promise daily liquidity. And in a panic, investors rush to redeem their money. Funds are forced to sell, and prices crash. In other words, high-yield debt is like the fuse of a crowded building. It looks harmless when the lights are on, but if too much stress hits the system, it's the first thing to burn. None of this is entirely new. The world has seen debt booms and busts again and again, from Latin America in the 1980s to Asia in the late 1990s to the European debt crisis after 2010. The exact details change, different currencies, different governments, different acronyms, but the pattern is surprisingly similar. You can think of it as a 5-stage cycle. Stage 1 is easy money. Interest rates are low, capital is abundant, banks and investors are eager to lend, and governments and companies borrow heavily, often in foreign currencies, convinced that growth will continue and refinancing will always be easy. Stage 2 is the debt pile grows, projects multiply, political promises expand, balance sheets get heavier, and as long as interest costs remain manageable, few people worry and debt feels abstract. Stage 3 is the shock. Something changes. Inflation, a commodity price shock, a currency crisis, or a global downturn. Central banks raise rates, or foreign investors pull back. And suddenly refinancing becomes expensive or impossible. Stage 4 is loss of confidence. Investors become selective. They demand much higher yields from weak borrowers. Rating downgrades hit. High-yield markets freeze first, and then even some governments find it difficult to roll over their debt. Stage 5 is the adjustment. At this stage, the illusion breaks. A country restructures its debt. A wave of companies default. Governments impose austerity with higher taxes and lower spending. And ordinary people pay the price in unemployment, cuts to services, and lower real incomes. Latin America's lost decade in the 1980s followed this pattern, and so did Greece and several European countries after 2010. The names and flags were different, but the logic of the debt trap was the same. So where does the world sit on this scale today? We are clearly past stage 1. The era of ultra-cheap money is over, at least for now. We are deep into stage 2. The debt pile has already grown. Global public debt is above $100 trillion. Total debt is more than double world GDP, and many governments are paying a much larger share of their budget just to service interest. The shock, stage 3, has already hit. Inflation surged after the pandemic. Central banks pushed interest rates up at the fastest pace in decades, and a long list of weaker countries and corporations are fighting just to refinance. Signs of stage 4, cracks in confidence, are appearing at the edges. High-yield borrowers facing refinancing at much higher rates, rising default rates in some sectors, and investors demanding higher yields to hold riskier bonds. Whether we move into a full stage 5, a large-scale debt crisis, depends on factors no one can predict perfectly: political decisions, central bank policy, and real economic growth over the next few years. But understanding the cycle at least answers one question. The situation we are in is not random. It is the logical result of a decade of cheap money, rising leverage, and the belief that debt always rolls over smoothly. For most people, terms like public debt and high-yield credit sound distant, something for politicians, bankers, and traders to worry about. In reality, the debt trap eventually reaches everyone. Higher public debt often means higher taxes or cuts to services in the future. Inflation, used as a quiet way to reduce the real value of debt, also erodes your savings and salary. And corporate debt problems can mean job cuts, wage freezes, or bankruptcies when the cycle turns. The point of this video is not to tell you what to buy or sell. It is to show you that when you see governments promising everything with no clear way to pay for it, and companies offering extremely high yields on their bonds, you're not just looking at generous gifts. You might be looking at the front end of a debt trap. History suggests that in every cycle, the people who suffer the most are those who ignore how the system is built, chase the highest yield without understanding the risk, and assume the good times will roll on forever. You cannot control when the cycle turns, but you can choose not to be the last person holding the most fragile promises in the system and in a world that already owes more than twice what it produces each year. That choice might be one of the most valuable assets you have.